Welcome back. A lot of effort and money has gone toward trying to solve Canada's housing shortage. Here's a look at some of that effort by the numbers. Let's start at the top. The federal government's national housing strategy, more than $82 billion earmarked for programs to get homes built. Of the almost $34 billion committed, the government says it has 107,000 new housing units built or promised. Part of that program is the first-time home buyer incentive. The government is offering 5 to 10% of a down payment in exchange for ownership in the house. Uptake on this program has not been enthusiastic. The recently announced Housing Accelerator Fund earmarks $4 billion to municipalities to come up with solutions to the housing crisis. And the Rapid Housing Initiative aims to spend $1.5 billion to fund 4,500 new affordable housing units. The tax-free First Home Savings Account allows for a tax deduction on up to $40,000 in savings, and withdrawals will be tax-free as well. Every province has housing initiatives of their own. Ontario's More Homes Built Faster Act aims to reduce regulatory costs to build 1.5 million homes over 10 years. Despite all the programs, Canada still has a sizable housing deficit. We need about 3.5 million more homes, according to CMHC. One of those programs, that Housing Accelerator Fund, is aimed at getting cities and towns to come up with new ways to spur building. Well, this week, CMHC said that, in fact, some of the land use regulations imposed by cities and towns is a big part of the affordability problem. Bob Dugan is chief economist at CMHC. Bob, thanks for being with us.
Oh, my pleasure.
So let's just quantify that. It sounds like, in other words, red tape to get from idea to shovels in the ground is part of the issue here. How much does that contribute, based on your research, to the affordability issues?
Yeah, to put an exact number on it is a little bit premature at this point because we just produced the survey. So this is a launch point for us to do more research. But what we have seen is there's a correlation in those centers where we have more regulation. There tends to be a higher or a lesser amount of affordability. So price to income ratios are higher in those centers where there's more regulation. And so that's a starting point for us to try to do more research and try to identify why that is. Because as you mentioned at the outset, Amanda, we have a housing supply shortage and, very strong demand growth as well. We have population growth. To meet the demands of these people, we need to really act on housing supply. We estimate that that gap grows to about 3.5 million homes by 2030. And so we have to look at all ways to improve the responsiveness of supply in order to get that job done and so that we can restore some amount of affordability to the housing market. And
definitely the preliminary numbers that you're showing, that first glance at this, it's clear that the bigger cities are the bigger problem. Toronto and Vancouver stand out in a big way. Can we extrapolate, and again, I'm speculating, but I think it's reasonable that a big city is more complex and there's just going to be more regulatory issues and more stakeholders involved, and it's kind of natural that you'll see longer delays in a place like that?
I think that's fair to say, and they're more complex. I think it's also a fact that, places like Toronto and Vancouver, as I mentioned earlier about population growth, well, they tend to attract a lot of that population growth because they're dynamic cities with lots of job creation. So people, whether it be immigrants or intra-provincial migrants, tend to gravitate towards where those jobs are, and that can put extra pressure on demand as well. And so they're complex to regulate. However, when you look at Toronto and Vancouver and compared to other big cities across Canada, they still have a lower amount of affordability and more regulation than, say, competing cities, so places like Montreal, places like Edmonton. And so while we can't blame the entire thing on the amount of regulation, I think it's one of the moving parts that we have to understand better so that we can do something about supply so we can restore affordability.
And you've just kicked off, opened up the kind of applications for this big pool of money available to municipalities and cities to innovate around these issues. Are you optimistic that that kind of funding is going to spur real change?
So what we're hoping to do with this survey as well is if municipalities want to take us up on those incentives, improve housing supply, maybe the results from this survey can help point them in the right direction to see, well, where are the log jams in their own systems from the data of this survey, and hopefully that can steer them in the right direction towards achieving some of those results and helping to improve housing supply.
Bob, so good to have you for this. Really appreciate your time.
My pleasure.
Bob Dugan is chief economist at CMHC. Well, one community is already innovating to try to change their housing story. In Haliburton, Ontario, Places for People fosters the creation of affordable housing. Well, now it's issuing community bonds to aid in that effort. Jody Curry is president of Places for People. Thanks for being with us.
Thank you.
So I'm intrigued at the notion of the bonds that you're offering. So just describe kind of the process here. This is a way to raise money to help fund the building of new housing units.
That's right. Community bonds are very similar to say GICs, except your money stays right here in the county. So individuals will buy bonds from us, and we will use those to position ourselves to create more housing over the next 5 years. They have interest rates and set terms just like GICs. They're backed by our property. We have $1.5 million in book value and $2.5 million in current market value, and we're raising $850,000 by this bond raise. So you can see we have lots of equity to cover the bond raise.
Do you know yet, Jody, what kind of interest there is in the bond offering? It's too early to say.
Yeah, we have all that information on our website at placesforpeople.ca, but I can also tell you that we have 3 different series. The first series requires a minimum of investment of $1,000, and you have to give it to us for 3 years, and we'll give you 3% yearly interest paid annually. The second one is a minimum investment of $5,000. We'll pay you 4%. And the fifth one is a 7-year bond at 5%, and that gets paid out like a mortgage. So you'll get interest and principal returned to you every year until it's paid out after 7 years.
So to me, a really clever way to kind of match, obviously, your needs to fundraise with also people that want to invest in their community. Is that your assumption? Is that because those are pretty good terms, certainly that 7-year term, a lot of people would find that very attractive. Would you attract, do you think, investors from beyond the Haliburton region, or do you think it will be people that want to be part of this community effort?
I suspect we will attract investors from beyond, largely also because we have a very seasonal population here. So many of those people live in the cities that you've referred to in the previous component or previous talk on your show. So lots of people from away, and then lots of people wanting to invest for their family members. We do expect it to go well beyond the county.
And you, obviously, Places for People is geared towards building more housing. What is the kind of growth rate that you've had? What are you kind of targeting, and what do you think your region needs?
Well, we're a very small not-for-profit, never had any government funding, and we've done it pretty much on our own with the help of the community. So we built 12 units over the last 13 years, and we want to double that number over the next 5 years. So this will position ourselves to do that and perhaps go to the bigger investors, the bigger people you need to borrow money from, and we'll have a great looking financial statement. But as I said, we will be doubling our numbers over the next 5 years from 12 to 26.
Do you feel as though, Jody, this is a model that other municipalities and communities should be looking at?
It doesn't just have to be about housing. You could use a community bond to raise money for any issue. And when you think about it, it's a lot like what used to happen in rural communities. When there was a need, a bunch of people got together, they threw money in a pot, and they made something happen, which is how Places for People came to be. So we've always been supported by the community. This is just a real formalization of that, and it's a way of putting it out there in the world that this is going on, and we want people to know all about it because we think it would be great for all sorts of communities.
Jody, thanks for being with us. Really appreciate your time.
Thank you for having me.
Jody Curry is president of Places for People. Coming up, can government save old media by taking on big tech? That's still ahead. But first, if you're feeling a little over-caffeinated, check the label on your beverage. Prime Energy is a drink peddled by a couple of social media influencers, which has 200 milligrams of caffeine per drink. It's being recalled by the federal government for exceeding caffeine limits by 20 milligrams. Prime shouldn't actually have found its way into Canada, but somehow landed on the shelves of 3 provinces. Ontario, Quebec, and Alberta all have a version of the drink not intended for Canadians, who have to settle for a lighter version with just 180 milligrams of caffeine. Just by way of comparison, that is 6 times the caffeine content of Red Bull or Monster. We're back after this.